Hey, good afternoon, everybody. Dennis Mattern with Creative One. I could not be happier to have you join me here today. We are going to be talking about volatility controlled indices and their performance. We're going to go through our index performance review. We're going to name some names, talk numbers. But first, a little bit of housekeeping. One, I say we. I'm here with my friend and colleague, partner in crime, Kevin Cloud. Kevin, welcome, sir.
Awesome to be here as always, Dennis.
And for a couple housekeeping items, one, in the invitation, the actual report for the month of July was included, but if you did not see it, let me know. I will get that emailed out to you. Also very, very important, and in fact, even more important now that I look to make sure that I've got my audio going, which I do, I want to point out on the right corner of your screen, there's a blue box and it says chat. And if you click on that, I'm looking right at the chat box. So if you have any questions as we work our way through this conversation today, if it fits the flow, I will ask it right then. If not, we'll save it for the end. We do a little Q&A every time. And then also we are recording, so we'll get a copy of that recording out so you can fact check Kevin. I'm color, so whatever I say is just kind of throwaway anyway, right? But regarding the chat box, if you do have a question, you can type it into chat just so you know everybody sees that. If you're feeling a little bit bashful, if you type it into the Q&A, only I see that. I will be your proxy. I will ask your questions. I will take the heat. How about that, Kevin?
I think there's no one better suited for that task than you, Dennis.
Very good. A very fair deal. Okay, so let's dive right in. Let's get cooking here. So here's what we've got. This is the actual report. One thing I want to point out, Kevin revamped this thing with the help of our design department, and they did an amazing job. When you get the report, the first page will have the kind of the building blocks, what happened over the last month. And then what you will also see is you go deeper, you'll see the index named, you'll see the name of the indices. There's a hyperlink off each one. The next column tells you what carrier is offering that indice. There's a check mark that says, hey, is it still available or not? Because there's a couple big ones that are out there that we still track. And then we do a 1 month, 1, 3, 12, 24, 5 years, 10 years performance based upon close of business, the end of the day last month. And then big breath, Kevin, because we're coming to the close on this part. This is one of the cooler things that I have seen. Kevin has broken down the constituents of that indice. So if you're looking for, you want to be a heavier weight or you want exposure to the large cap United States, boom, you can see that. If you're looking for commodities, you're looking for gold, you can find that information. And then all the way on the right, you see the actual volatility measure of that indice. Kevin, I have to give you massive props because this report is unbelievable. I have seen some flattery in the form of imitation out there.
I've seen the same thing. It's hard to keep that contained. I guess I don't own formatting. I will say, I think this is a great report. Our design team did a great job. I don't think this should be the end of your index research if you're an advisor. I do hope it's the beginning. I think there's a lot here you can glean, get an idea of what's out there, things you might like, and then you've got 100 or so handy dandy links, like you mentioned, you can go and really dive in. A lot of these microsites are really well put together, and you can glean a lot of information by going from there.
Couldn't agree more. And in fact, the start of the journey, I will say that, volatility control indices, I am a fan. I think they've been misapplied. In fact, Kevin, I'm going to tell you this. I was at a conference, a carrier event, started talking vol control with someone. Yeah. I thought it was going to come to hands.
Really?
I thought we were going there.
Wow.
But you know what? I said, hey, let's cooler heads prevail. Let's talk volatility. Speaking of that, okay, moving on. Here's what we're going to do today. We are going to talk index performance. We're going to talk strategy performance, which means we are going to look at what happened in the real world. What did your client see on their actual return?
It matters a lot when you have participation rates ranging from 30% to 300%. It really matters what it is when you all put it together. I tell you, it's not just index performance.
I couldn't agree more. And then we're going to dive into some analysis. So a couple key things here. So when we are looking at this, on the report, we have the gross returns of the indices themselves. I laid out the time parameters a second ago. But what we're going to do on this next page, and I'm going to go ahead, we're just going to go there. What you're going to see is the actual return. So what Kevin has done is a massive amount of legwork. I am giving you a lot of props today.
I know. I feel really, really good about myself right now.
All right. So Kevin has done a massive amount of legwork. And what you're looking at, so for example, top left, and there is a lot here, you see the actual change, the gross change of the indice. You see what the strategy was and then the factor. So I'm going to walk you through this, and we're going to go down because I see a lot of negatives. You go down about a quarter on the left, you see the Barclays Atlas 5, you see the gross change, and then you see what was available 12 months ago. If you had put somebody in this indice, it was available on a participation rate. The participation rate was 245%, and then you see what it was credited. Kevin, I turn it over to you. I see a lot of negatives at the end of last month.
I think that's correct. There are a lot of negatives. So that's just, let's call a thing what it is. It is what it is. We're going to cover why I think there are a lot of negatives, and we touched on this last month. And so we're kind of build on that conversation on why we're seeing so many negatives in volatility control indices when, we see a lot of positive returns in benchmark indices. So why are we seeing a bunch of negatives? I think there's a particular reason for that, but I also see, even though there are quite a few negatives, there are quite a few bright points as well. Some indices that did do a very, very good job in delivering value to clients.
I love it. Okay, so we're looking at that. I did. Somebody just put in a Q&A to me. They just made the point, how come I don't see the par rates on some of those? In the matter of efficiency, if the number is a zero, or if the gross return is a negative number, a negative return number, the beauty of an indexed annuity, and we need to remind clients that zero is your hero. So Kevin didn't finish it all the way out because you know what? It was going to be a zero.
Until I get a lowly paid intern dentist, I'm going to continue to only do the positive ones.
All right. Well, let's dive in. So what are we looking here then?
So naturally, what's really important, as you mentioned, is what are the actual returns to your clients. And so these are not the top 10 returning indices. These are the top 10 crediting index strategies over the last 12 months. So the largest credit that I could see over the last 12 months was actually the S&P Mark V. They're at one, now that indices in several companies, but at one company, you could have gotten a 200% participation rate, which would have given your client a 9.53% credit over the trailing 12 months had you allocated to that particular index in that particular strategy at that particular company.
And I do want to remind everybody, as you're looking at this chart here, what we're doing is we are looking at, because a knock on vol control indices, and I feel the same way, is that when somebody presents it to you and they throw it out and you see these amazing numbers, you're like, oh, okay, well, when did that happen? Like, well, that's how it would have happened hypothetically because we just made this yesterday. What we are looking at here is actual returns on actual products. And so we're not, this isn't about cherry picking. This is about showing potential. And again, I do want to remind you that we are looking at the close, literally the close of business. It's on the top of the slide, but the close of business, the 30th of June in the year 2025.
That's correct. There was some policy with a policy anniversary on June 30th, 2025, where a client had allocated to a Mark V index strategy on a par basis, and they got a 9.53% credit.
Bang.
That actually happened. That's out there. A lot of the pieces, including our own that's public, only look at the return of the index itself, which is important information. Putting it together with an actual index strategy that shows a real world return, we think that's hugely important. And so that's what we're showing here. S&P Mark V.
Doggone it, Kevin. I'm going to give you another compliment. This is why what you added to the report, I think, is so important, especially to really understanding vol control indices and where they can fit and maybe how much you should use. And that is that constituency that you put, that you can at a glance see how much, not how much, but where is this index looking for returns and how much is the vol control? Because too often in the past, this was presented as some kind of panacea for bad returns. And then what ended up happening is you have a whole bunch of people that have a bad taste in their mouth because they went in the wrong way. Okay, I'm done preaching. Go.
So given that, we explained what this is on this chart, the Mark V. These are the top 10 actual credits you would have gotten in vol control index strategies over the trailing 12 months. So Mark V, PIMCO Balanced, BlackRock, iBuild Claria, and so on and so forth. Go ahead one slide and we compare that to the 12 months ended on 5/31. So on the darker blue, that's where we are this 12 months. The lighter blue, that's the 12 months from a month ago. And you can kind of see we see a lot of the same constituents.
I got to back up.
All right, go ahead.
Just so I'm on the same page. The left side of the screen, the dark, is the returns as of June 30th.
Correct.
And on the right side, the lighter blue is the returns the end of May 31st.
Correct.
So the end of May. So end of June on the left, end of May on the right. Go.
Right. May on the right, that's where we were last month.
Okay.
On the left, June, that's where we are right now, or the end of June, as it were. And you can see a lot of the same same indices are showing up in both places, which I, of course, find interesting. Want to find out why. In the past, we've looked at the PIMCO balanced, and while we love to look at all of the indices every month, can't do that. But we're trying to go through and explain, why are these indices doing better than their peers? And I think that's really important to understand. So this month we're going to look at the Mark V. I'm going to get a little bit of extra info on that one. I am quite grateful.
Wait, I have a question before. Kevin,
I'm sorry, go
for
ahead.
those of you that can't see, Kevin is giving me the, hey, move to the next slide. But I have a question. So what would be interesting, and I'm going to do this off when we're done, but
Okay.
what would be very interesting would be to grab the report and lay it here and look at the constituents of this, which is maybe where you're going. But I'm sorry.
It is exactly where I'm going. So very, very grateful. A lot of times I have to do this analysis myself. Fortunately, S&P did this for me. This is an attribution analysis and allocation analysis for the Mark V.
Okay.
So it's showing you, so at the top, you'll kind of see where their allocations were. So this uses effectively risk parity. They're trying to get the same amount of total risk from each of the constituents, and that's how they do the allocation. So if one particular constituent is very risky, it will have less of an allocation. If it's less risky, it has more allocation. That's the idea. So you can see up at the top, the allocation to the S&P Mark V as of the end of June was 15.11% equities, 55% treasuries, nearly 15% gold. That adds up to about 85, which means 15% was in the remaining 15%-ish was in cash. And then one more to the right, you kind of see where it is over the trailing 12 months. Not really that different. Maybe a little more in equities, a little less in treasuries, but about that same amount in those constituents on the trailing 12 months. Here's what's great. If you go down, you see that Exhibit 3, contribution to return. This is attribution analysis. This is how the Mark V got to that 4.76% over the trailing 12 months. Its actual contribution from its equity sleeve was negative, which is interesting because most of the time when you have a negative equity allocation or a negative equity attribution, you don't get a return in your index. Treasuries were modest but positive, which is a good thing. Here's why Mark V did so well. And those of you who know the index are probably not surprised by this. It has a significant gold allocation. And as you and I have talked about before on this index, gold has done pretty well over the trailing 12 months. And this index took advantage of that. Other interesting thing I didn't know, we'll pass along. Most of the time when there is a cash sleeve inside a volatility control index, it does not, that cash is credit 0% based on the rules of the index. This index, that's not the case. Its cash allocation actually earns a rate of interest. So you see there's a cash attribution that's not insignificant over there on the right. So between the gold and the cash, that's roughly 5.5%. There's some other things that go into it, but rough analysis, gold drove it, cash contributed to it, and equities and treasuries didn't necessarily drag on it. Really interesting. Gold was the main story here. It's been the main story a lot, but that's what drove the Mark V. So if you're a fan of the Mark V, the question, of course, number one, did a good job allocating. Number two, the question is, do you think gold will continue to drive it? If you don't feel quite as optimistic about gold going forward, is this the index for you? But otherwise, attribution analysis. Thank you, S&P, for doing the work for me. I appreciate it.
Two things that come into my mind, right, as I'm looking at this. One, I would love, maybe we should offer a cash bounty of some sort, but I would love to hear the stories. In selling, it's about stories and getting people to see your vision or, explaining it to where they understand it. I would love to hear people's stories on how they explain or their favorite analogy when it comes to volatility controlled. Because in my mind, I think about sailing, like adjusting, the wind is coming, you adjust your sails, or maybe like reloading the wagon to make it easier or something. I would love to hear other people's analogies. The other thing that this really also points out to me is the great opportunities for those conversations when it comes to reallocation on an annual or whenever the reset period is, because there's some great opportunity to get in front of your clients and have deeper conversations about maybe that chunk of money you didn't get, or just staying sticky. Let's keep going.
Absolutely. So the other thing we like to look at, so if you were with us last month, and Dennis, maybe you remember, one of the, or maybe not, one of the things I thought was super interesting was vol control indices didn't seem to fare very well during the kind of V we had in the market. So there was a big concern about tariffs, market plummets, tariff concern is ameliorated, markets come back up. So the white line you see on this graph is the S&P 500, and you can see the market had peaked around March, takes a big dive towards the middle of April, then basically comes all the way back up and a little more by the end of June. So that's the market that we saw. The green line is an S&P 500 10% volatility control price return index, which is just about the most simple form of volatility control you can get. There's no excess return in there. There's no allocating to different constituents. It's the S&P 500 with a 10% target volatility control on it. That's it. So what's happened in a lot of cases, not all cases, but a lot of cases, basically the market went down pretty quickly, introduced a ton of volatility, and then went back up while still the market experienced a lot of volatility. When there's a lot of volatility, what happens? The volatility control indices are getting out of those risky assets. They are not reflecting the movement. So you can kind of see just after, we'll say early mid-March, S&P starts to go down quite a bit. The risk control version pulls back a little bit. It's not going down nearly as much. The green line and the white line was way ahead, and the green line was behind, but they almost converge in middle March. And see, there's a big spike in volatility, right? That means that the vol control version is not reflecting the underlying index. It's pulling out because there's volatility. That's what volatility control does, right?
Yep.
All right. Now, fast forward a few months, we see volatility spike. That's the light blue graph behind. That's volatility. Volatility spikes. The green line, our volatility control index, isn't following the S&P 500 all the way down. But as you see, what we had was a V-shaped recovery, really quickly down, then really quickly up, effectively over a 3 or 4 month period. The problem is that recovery started when volatility was still high. And so during that recovery, the volatility control version is not capturing the upside. It stayed out of some of the downside, not all of it, but it's not capturing that quick upside on the way back because its market is still volatile, and the index by its very way it's constructed is staying out. What's super interesting is you see the right tail over there, which is basically the last half of June. You see volatility has come down quite a bit, and what has happened to our vol control index suddenly is capturing those gains again. And you can see the last, I would say, 15-ish days of June. Our 10% vol control index is more or less matching the S&P 500. So this is just one index, but this is how volatility control typically works. And almost every index has its own version of volatility control. So it's not going to be exactly like this. But what I think we found is these really rapid V-shaped market downward trends followed by quick recovery are not the best environment for a volatility control index.
No, you know what? As you're saying that, what I'm thinking is it's like the vol control when the volatility spikes, the vol control is looking for its foxhole. It's like I'm going to make sure everybody's okay, and then you miss out on that because that's what it was designed to do, though.
Correct. It wasn't necessarily built for this condition. I don't know if this condition is how common these V-shaped recoveries, these really quick, recovery during high level volatility environments are, but that's what's happened. I think that's why we're seeing the lag in performance from most volatility control indices. Let's see how it plays out over the next few months. See if if volatility stays low, it can continue to capture those gains, and we start to see the positive returns we expect from our volatility control indices. But I'm convinced this is the driver for most indices having muted performance over the last 12 months. It's that 3-month period from March, April, May, where it wasn't tracking the index.
It'll be interesting to see as we, as we're broadcasting now. There's been more the last couple of days. There's been tariff rumbles again.
Yes.
So it'll be interesting to see what you have to say, the analysis you'll have for us here next month, which will be the second Tuesday of August.
I do plan to
3
continue
p.m.
this. I think it's super interesting. I think the visual helps me understand. I hope it helps other people understand exactly when the volatility control index is gonna reflect its underlying constituents.
I'm not going to lie. You're on like a 3-month streak of where you've actually made me go,
Wow.
positive.
I'm
very complimentary today.
I know.
Has nothing to do with me owing you $10.
I
All right. So we're going to switch gears then. So we've talked annual resets. Let's talk 2-year resets. And again, same scenario here. So one, as you work your eyes around here, what you'll see is the name of the index. You will see the gross change over the 2-year period, 24-month period, ending June 30th. You see the strategy, you see a factor, you see the credit. You're going to see a lot of zeros. I see actually, I'm going to ballpark that at maybe 50% zero, 50% positive returns.
would have put it 60-40 positive.
Oh, okay.
But
You're more of an optimist than I am. But so what you do see is if you bring your eyes down, actually go to the top right corner, you see the Loomis sales. You look over the gross indice, 3.7% to the positive over the 2-year period. It was available in a par strategy. It was available at a factor, a participation rate of 285%, which meant your client over the 2-year period, not annualized, over the 2-year period, would have got an 8.74% return. Kevin, go.
I think we're seeing a lot of the same reflections of volatility in the 2-year that we saw in the 1-year. Again, a lot of pretty muted performance. I think a lot of that has happened over the last 3 months, where these indices were tracking a lot better, and then things went off the rails with volatility and the quick recovery. But let's look and see what actually did well over the last two years. So again, we see Mark V did very well. Again, gold has done really, really well over the last 2 years, and so that index would be reflective of that gold performance. Then we see SG Macro Compass, Citi Flexi Beta 5, a mouthful there. But again, I think in a minute, or as soon as you get ready, we'll show where we were last month. I think we're going to see a lot of the same indices doing pretty well. So yeah, I see the Mark V close to the top, the Macro Compass. A lot of the usual suspects continue to do well under these circumstances. And of course, the question is why these over others? And we're going to look at a few in just a moment.
Let's take a look. I have a question. I'm going to actually write my question down because it doesn't fit the moment. But Kevin, what are we looking at here?
So this is the Citi Flexi Beta 5. It's done pretty well over the last 2 years. I think this one is super interesting because basically over the 2-year period, it had a very reasonably short period of run up between October of 23 and April of 24. It got most of its return right there. And it's been basically flat, little ups and downs, but basically flat for the remainder of the 2-year term. And you can also see, so
wait, I have a question.
Yes.
Left side of the screen, I see like numbers in the 200s. I don't mean to be dumb, but what am I looking at there?
That's the value of the index.
Okay. Thank you. Sorry.
I just stole this one from the Citi website because I didn't want to make my own chart, but that's basically what's going on. They saw a big run up at the end of 23, the beginning of 24, and it's been ups and downs, mostly level since then. But the important thing to note is that it wasn't swamped like some other volatility control indices were during spring of 25. They went down some, but it's also recovered. And actually, this kind of return profile last 2 years is very similar across some of the other indices. Has performed well. They had a pretty good run up between the end of 23 and the early middle of 24, and then have basically stayed the same. This profile I saw a few times. So the question is why? What happened? It's not. I mean, it's relatively intuitive. So the Citi Flexi Beta 5 allocates back and forth between two portfolios. And you can see down below they have something that's called their reserve allocation and their core allocation. It uses a trend signal and a risk signal to decide when it's going to the core allocation or the reserve allocation. The reserve allocation is its safe spot. So that's very safe assets. That's the lighter blue in this chart. The core allocation is actually multi-assets. It has a bunch of different things in there, including gold. It also has some international equities and U.S. equities, bonds. There's quite a few things that go into the core allocation. But when things start to get a little bit risky, or if the trend is negative, it will get out of that core allocation and go back to the safety of the reserve allocation. Now, you can't see it really, really well, but if you look at the beginning of 25, you can see in the middle there, it got out of that core allocation into its safe reserve allocation. And then in the last couple of months, it's gotten back into the core and it's been able to ride up a little bit. And if you go back to the previous graph, you'll see it went down, but then it was also able to capture the backup. And basically it didn't lose any ground when some of its brethren were unable to capture that.
Interesting. So what Kevin is describing is over on this graph, over to the extreme right side. And you see that dark basically go to light and then dark again.
Yeah. So its trend mechanism and its risk mechanism basically told it when to get in and get out, and it worked. But it's also really interesting, for most of 23 and 24, it was in that core allocation. It was capturing the upside, and we saw that during that one period in late 23 and early 24 where it captured a bunch of upside, and that's where the index really had its performance over the last 2 years.
We're working our way towards the end. I do want to remind everybody, one, we're recording. Two, I will get a copy of the report out to you when we're done. But three, if you do have a question, don't forget, bottom right corner of your screen, there's the chat box. You can hit chat. You can write a question in. If you're feeling bashful, you can type it in Q&A. If you type it in Q&A, I will be your proxy. Okay, so now we switch to interest.
Yes. So we always like to cover this because I think it's super important. Just today, the inflation reading was released, so we're going to cover that in a minute because I think that's super important to what we're going to see interest rates going forward. We'd like to look at 3 different interest rates on this webinar. One, of course, is the 10-year, which is very indicative of the direction of rates that impact fixed indexed annuities.
Which is the darkest in the back.
Which is the dark maroon in the back.
Gotcha.
A lot of stability in the 10-year. It's bounced around a little bit, but for the most part, it's been range bound between 4.3 and 4.5 for most of 2025. It had that one little dip in the spring, but largely been between 4.3 and 4.5. Same with the 3-month, which is very, very reflective of Fed policy and what they're doing on interest rates. They have been moving on interest rates, and so that rate has been very, very steady. What you see on the 2-year is more of a prediction of what the Fed is going to do in the short term. There's a lot of belief the Fed will start to cut rates, and so you see that 2-year start to trickle down. So I think the 10-year is more reflective of long-term views on inflation and U.S. debt. So that's been staying a little bit elevated. 2 years more reflective of mid to near future Fed policy, and then 3-month is current Fed policy. And so you kind of see there's some belief that rates are going to go down. What's really interesting was inflation numbers were released today, and we actually saw bits of uptick. So this is actually trailing 12-month inflation for core CPI and regular CPI, which I assume is CPIU. Saw upticks this month on the trailing 12-month. There's been a lot of belief that rates, I don't want to say this, that rates were going to be going down, that the Fed was going to decide to lower rates sooner rather than later, perhaps as early as July. This probably more or less nips that in the bud. We see an uptrend in inflation. I don't think we're going to be seeing a rate decrease in July, and I would suspect not for August either. But we'll see. But very, very interesting. We saw upticks. I think people are looking for that to go down. I don't see the Fed lowering rates. That's probably good for our business. In the meantime, it should keep rates elevated. Looking individually at core CPI and CPI, if you go to the next slide, these are the actual monthly rates. So how much it changed. So you're looking at the trailing 12 months. So basically from June to July, that's the 12 months that we're looking at. And so every month, the last month falls off, a new month comes on. So what you'll see is last July, we were at 0.1% monthly. That number is going to fall off next month when we get a new reading. And so it's very, very likely the trailing 12-month CPI number is going to go up. Does that make sense? Mm-hmm. So something to look forward. But again, I think that makes it less and less likely that the Fed is going to is going to cut rates. This is that same number, but with core inflation. So you see last July, it was at 0.2. That number is going to fall off next month. A new reading is going to come on. Again, I don't suspect we're going to see a tremendous amount of change in this core inflation reading. It'll probably stay, if I had to guess, it'll stay where it is, but that's still above the target 2%. I don't think the Fed is going to take these data points as reasons to lower rates.
Mm.
Very, very important to what we do. I think rates stay the same, and markets will reflect that.
You know, the real question, Kevin, is when can I refinance?
You
Because I
will-
bought a house at the worst time.
I personally I've been wrong more than I've been right. So with a grain of salt, Dennis, I do not see mortgage rates coming down.
Thanks for nothing, Kevin.
If I were King Dennis, I'd do what I could. But
Thank you.
am
I
not.
appreciate it. Okay, so everybody, here's where we're at. We are at the end of our prepared section. If you do have a question, feel free to type it in here. Chat. Everyone sees your question. Q&A. Only I see it. I will be your proxy. A couple things. One, we did record. Two, I will be sending everybody that's on here a copy of the report just to make sure that you have it. And then three, we do this conversation the second Tuesday of every month at 3 p.m. Central, unless something comes up where we have to reschedule. So the one question, if I'm going to take a pause, I do have a question, Kevin. I'm very curious. Do you think, as a product actuary, Kevin's got the look of where are you going with this? Because he doesn't know what I'm going to ask him.
I take all comers, Dennis. Whatever you got.
So we've had multiple conversations about two-year design, 2-year resets.
Yes.
And my thinking is that so many people have had some bad experiences that I feel like people are going to gravitate away from it, although I don't have any data on that. My thought was, just as you were talking earlier, is back in the day, when I first got into business, there were a lot of indices that did, it had a weird name, but I'll just describe it. It had whatever it was, it had averaging the last month, the last couple days, the last blah, blah, blah.
So not the whole term, just the end of it.
So
Yes.
yeah, it would be maybe a point to point, maybe a par rate, but when it would get to the last month, it would go to maybe daily averaging for the last 2 weeks
Yes.
or the last month. Do you think that we will see a return to that design on 2-year resets?
No.
Why not?
Complication.
You know what it would be, as I say that, complication equals expense. Expense means lower par rates and less attraction.
I mean, I think it's just, I haven't seen, and our audience can correct me if I'm wrong. I
haven't seen it in years.
I haven't seen anything like that in years.
Decades, actually, which is sad to say.
I think it has complication given the fact we already have things that are supposed to control volatility. I don't know that that function necessarily makes sense. I think it's interesting when you look at a lot of what volatility control does, it's actually supplanted what we used to build inside the strategies themselves. So for example, the monthly sum cap, if you remember that, it's still available in a few products as a strategy, but there's also some indices that have actually taken that construction and built it into the performance of the index itself. So you no longer have to do it inside the product. So, and really you could look at volatility control as the same thing. What is volatility control at its heart? It's effectively a dynamic participation rate. So I think a lot of the mechanisms that we used to see are probably better implemented elsewhere. And so I think that's my answer.
All right, I'm just saying. I think we're going to see this being offered here, maybe in the future.
Wow!
You heard it here last.
Ooh, I feel like there's some breaking news. You're like the Rita Skeeter of the annuity world, Dennis.
Yep. Hey, do you hear that? You know that idea we used to use 30 years ago and nobody does anymore? Let's try it again. Okay, so here's what we're going to do. We're going to call it a day, unless we have any last questions, and we don't. So I would like to say thank you on behalf of Kevin Cloud.
Yes, thank you, Dennis.
Yeah, okay. Well, you didn't have to say thank you.
Okay.
But thank you for taking time out of your busy day. If you do want to have a conversation and dive into the weeds on these different indices, their attributes, why this index, why now, we have sales folks that are happy to have that conversation with you. Go through the ins and outs. They have internally, we have software. Externally, there's software where we can get into the weeds and see what fits, because there are some great options and opportunities out there. With that being said, thank you for your time. We appreciate it, and we'll see you next time.